Welcome to From Where I Sit. I'm your host, Tom McGee, President and CEO of ICSC, the preeminent membership organization serving the commercial real estate and retail industries. Each episode, I'll be joined by top experts to explore the trends impacting communities and commerce and the spaces where people shop, dine, work, play, and gather. I'm excited to introduce a good friend and one of the country's top economists, Mark Zandi, joining us today on From Where I Sit. Mark is the chief economist of Moody Analytics and one of the most quoted economic experts in the U.S. Mark, welcome to the show.
Hey, Tom, it's good to be with you. Thanks for the opportunity.
Yeah, thanks. It's great to have this conversation with you. Well, we're going to have a wide-ranging conversation today, but before we get into the details of, economic metrics and whether we had a soft landing or not, one of the things that struck me is, coming out of the pandemic, the U.S. economy, to me, seems to have recovered more quickly than the rest of the world. Just your perspective about, one, do you agree with that? And secondly, why, if so?
Yeah, totally. I agree with that. You can see it and pick your statistic. I was just looking report from Europe, and they're bemoaning the fact that the U.S. productivity growth, which is, obviously a key part of the growth in GDP output in the U.S. Since the pandemic has been twice as strong as in Europe. And this is the case across most every economy, particularly most developed economies. So yeah, absolutely the case. I think, Tom, a bunch of reasons for that. I think kind of at the top of the list is just the policy response to the pandemic. Our response was just so massive, not only in terms of monetary policy, which other central banks around the world followed, but really in terms of fiscal policy. If you add up all of the support to the economy that was provided, beginning with the CARES Act in March of 2020, that was when the pandemic began, to the American Rescue Plan, which was March of 2021. That was early on in the Biden administration. That was I'm rounding obviously, but $5 trillion worth of support, deficit finance support, and that brings up another issue. But that's 25% of GDP. That's checks, that's help to small business, that's mortgage forbearance, that's on and on and on. And that compares to an average of about 10, maybe 15% of GDP in the rest of the world on average. No one comes close. So that got us out of the grips of the pandemic economically, very, very quickly, and ramped things up. We also got a little bit lucky. The other big shock to the economy was the Russian war in Ukraine. And of course, that did a lot more damage to Europe than to us. I mean, the Europeans, particularly Germany, was very tied into Russia, particularly for energy, natural gas. And of course, we're very lucky here in the U.S. We produce a lot of fossil fuel, never had any problem with natural gas through the fracking. And even oil, we've ramped up oil production here to record levels. And so that's helped to cushion the blow. And then the other thing I'll mention, and again, there's a long list, but I'll just want to mention one more thing. This has historically been the case that the American economy is just much more flexible. We adjust much more quickly to shocks. That's because we allow for failure. Businesses fail and those resources are freed up and go to another use, and the economy adjusts and adapts, and people move. Less so this go around because of the fact that a lot of people locked in low interest rates and have been very reluctant to move. But even despite that, we've seen a lot of movement of people from one part of the country to another, and that flexibility allows the economy to adjust to shocks. You just don't see that in the rest of the world, particularly Europe or Canada or Japan or Australia. People don't move, and they're much more reluctant to allow businesses to fail and for those resources to get freed up to go to a better use.
Pretty dynamic economy. The U.S. it's just so vibrant. You did mention one thing around fiscal policy, the $5 trillion, et cetera. I want to touch upon that because that obviously has some impacts on government debt levels and GDP to debt levels and so forth. But before we get there, today we're sitting in what I would consider a fairly solid economy. There's different perspectives around the strength of the economy, but certainly, GDP continues to grow. The employment market's relatively, certainly strong. What is your perspective on where we're at today from an economy perspective? And what are some of the risks that are out there that could impact our continued recovery?
I think we're in a great place, at least in aggregate. I mean, I think, I have this metaphor in my mind of the economy as this big elephant, and depending on which part of the elephant you touch, you obviously would get a very different perspective. But if you take a step back, like an economist would, and take a look at the totality of the elephant, doing really well. I'd even go so far as to use the word exceptionally well. Strong growth. I mentioned GDP, but jobs, we're creating lots of jobs. Unemployment is very low. It's just around 4%. That's full employment. It's low across all demographic groups, from educational attainment to ethnicity and gender, and across the country. Inflation had been the blemish, but even that's now back in the bottle. Stock market's at a record high. Seems like we hit one high almost every day. Housing values are at record high. Households did a really good job of locking in the low rates, previous low rates, and have been insulated from the run up in rates. So yeah, it's a very, very good economy. Now, again, I'm speaking with a broad brush and in aggregate, and there are blemishes. I do think there's a distinction to be made between folks at the top part of the income distribution. Let's say the folks in the top third of the distribution, they're doing fabulously well financially. And folks in the bottom third of the distribution, they're struggling because they don't have the savings, they don't own stocks, they don't, in many cases, own a home. They got nailed by the high inflation 2 to 3 years ago. They took on credit card debt, consumer finance loans, buy now, pay later, to help supplement their income to maintain their purchasing power, which was, you could maybe manage that when rates were low, but now you're paying 22% on a credit card, a record high. So clearly distinctions to be made across the economy, but in aggregate, very difficult to find other points in history where we're performing as well as we have now. Now, in terms of the risks, there are risks. Although I will say, Tom, the risks are more symmetric than they've been in a long, long time. I mean, they've been almost universally to the downside since the pandemic hit, but it feels like there's some opportunity for the economy to do actually a little bit better than most people anticipate, and we can talk about that. But on the downside, the kind of the catch-all geopolitical threats, and at the top of that list, I would put the U.S. relationship with China. It's a obviously the biggest economic relationship in the world. It's very vexed. We're moving in different directions, and that's just not a healthy place to be. And we've managed it so far, but the odds that somebody makes a mistake here are not inconsequential. And if they do, then that could certainly derail the economy, and we go from an exceptional economy to something that's much diminished. So we've got our risks out there, but for the moment, hey, Tom, I'd say soak it in. I enjoy this. This feels from a broad macroeconomic perspective, it feels pretty good.
Have we achieved that soft landing? When do we declare victory that the soft landing has occurred?
I'd say mission accomplished. I mean, the only reason why I would hesitate is, the Federal Reserve still has work to do, right? The Fed jacked up interest rates in an effort to cool things off. They succeeded. They achieved their mandate of full employment and inflation back at target. And they've now started to cut interest rates, but the federal funds rate target, the rate they control, is at 5%. It's down from 5.5%, but it's 5%. And they will continue to cut here, at least if they stick to the script they've laid out for us. But I don't know that you can truly exhale until the interest rate's back to something that's more typical, normal. And I'd say that's probably closer to 3. So that may take a year and a half before we get back to that. And I think they'll get there. I think odds are very high that they'll pull this off, and we should be fine. So I say mission accomplished, but I can't quite exhale yet until interest rates are back down to something that we would consider to be, more typical historically.
Thank you for that. One of the things that, I always worry about, having gone through 2008 and kind of the unexpected, the quotes, black swan type of events. Are there any things out there that you see and say, gosh, there are some troubling signs that maybe there's this black swan kind of event that could impact the economy that most people aren't talking about right now? I get the geopolitical risks, I get the election risks, but is there an asset bubble out there somewhere that, geez, if something happened, that's going to really cascade the economy? That, whether it's something similar to the housing crisis that we experienced in 2008.
Well, I don't think there's anything that existential. That was pretty bad. But I'll call out something that is bothering me. I'll put a stake in the ground, and Hopefully it doesn't happen, but if it does, then your listeners can say, oh, I heard Zandi say this and be prepared. The bond market, the treasury bond market, the corporate bond market, it's not well functioning. It's kind of choppy. I mean, when I started watching the bond market, I don't know, 3 decades ago, the 10-year treasury yield moved 2 to 3 basis points in a day. That was a huge deal. Now it's moving 20, 30 basis points in an hour, it feels like, lots of volatility. And I think that partly goes to the fact that the large broker dealers, the parts of big banks that make these markets, haven't expanded those broker dealers, the balance sheets of those broker dealers to keep up with the rapid growth in debt. Going back to what we were talking about earlier, all that treasury borrowing, all the deficits in debt. It's also in the corporate bond market, lots of borrowing. And the reason that they haven't done that is because of liquidity rules, capital requirements that just make it uneconomic for them to do so. So the markets are just feeling a lot choppier. And then adding to it is the Federal Reserve is so-called quantitative tightening. That means they're allowing the treasury securities and mortgage securities that they bought back when they were QEing to help support the economy in the pandemic, they're allowing them to run off. So they're exiting these markets, and the entities that are coming in to fill the void aren't other central banks. Like, the Chinese are exiting out slowly as well. It's not even the banks themselves because they got nailed by the banking crisis a little over a year ago. It's the hedge funds. They're coming in and now becoming a bigger part of those markets. And they're very price sensitive. They're there when things are going well, no problem, but they exit very quickly if things aren't going well for whatever reason. And they all go at the same time. And we get into another treasury debt limit battle. As you may know, the treasury debt limit was suspended until January 1, 2025, and then it kicks back on by law. The treasury will run out of cash by the middle of next year if lawmakers don't get it together and suspend it again or increase it. And you can see kind of a real political battle brewing at that point in time. And all these things come together and we see, let's call it a liquidity event, liquidity crisis in the bond market. Now, the Fed presumably could step in and provide liquidity, lower interest rates. Certainly could do that. It could help out the treasury market quickly, but not so much the corporate bond market. So that's the kind of thing could happen, some kind of financial event. And that could potentially be that black swan you're talking about. Not on the par with the housing crisis, the financial crisis back a generation ago. That's a whole different ballgame. That was just really credit. This is bad in lending decisions. This is not that. It's just a liquidity problem. But liquidity problems can turn into solvency problems pretty fast.
Let's talk about that levels since we're on the topic. And obviously, debt to GDP ratio in the U.S. is at 120%. The trajectory is clearly going north right now. Just talk about the consequences of that. What happens at some point? What's too high?
Well, as you point out, it's more than double what it was prior to the financial crisis, the generation ago. And if you look at the future under current law, say policymakers don't change law, then the debt to GDP ratio will be 170, 175% 30 years from now. Good rule of thumb is for every percentage point increase in the debt to GDP ratio, it adds 1 to 2 basis points to the 10-year yield. So you can do the arithmetic. If we're sitting at a 4% 10-year yield today, that trajectory suggests that 30 years from now we'll be at 5%-ish or even higher. But the world, of course, is not that linear. It's a very nonlinear world. And so it may be 1 to 2 basis points for 1 percentage point debt to GDP ratio today. But if you're sitting at 150% debt to GDP, it could be 3-4 basis points. And then at some point, it goes parabolic. Because investors are going to rightly question, are they going to get paid on time? And probably that's going to happen. And that kind of dovetails with the black swan event I just described earlier. That probably happens around some kind of governance issue, like a debt limit battle or a government shutdown. We're just so dysfunctional, we can't figure it out, and lawmakers can't get it together. Certainly, if they default on the debt, that would be a catalyst for a complete mess. When that happens, I don't know, Tom. I have been thinking not next quarter, not next year, probably not in the next decade, but now I'm not so sure. I do think there is a potential under certain scenarios with regard to the makeup of government and our political situation where this may be a bigger issue sooner rather than later. And by the way, maybe that would be a good thing. Maybe we need a crisis We need those bond market vigilantes to come out and say, hey, I'm not buying your debt at these interest rates. You're going to have to pay me a lot higher rate to take the risk. We need that so that lawmakers can connect the dots in the minds of the electorate that, we have a choice here. We can go down the current path of large deficits and debt and look what the world looks like, or we can make the better choice of restraining government spending and increase taxes to change the trajectory of these fiscal situation. And that crisis might be the thing that we lawmakers need to be able to get the political will necessary to do that. In fact, it almost feels like that's what's got to happen here, because I just don't see us generating the political will to address this unless we're absolutely forced to do it. That old adage, I used to think this was from Churchill, but apparently Abba Eban, Americans try everything and then they ultimately do the right thing.
Yes.
That's going to apply here. We're going to do everything we can to screw it up. And hopefully at the end of the day, we do the right thing.
I thought that was Churchill who said that also. Mark, let me ask you one other question. 1 month, 3 month treasuries are offering a yield in excess of the 10-year treasury. To me, that still doesn't make sense. What's the market telling us?
Yeah, well, that goes back to the question about the soft landing. Remember, I said I wouldn't exhale until we're down to a 3% funds rate target, because that would mean if the 10 years at 4, which I think is roughly where it should be here in the next year or so, that's 100 percentage point positive spread. And that's right. That's good. That's what we want. But right now, you got a 5% funds rate and you got a 4% 10 years or 100% upside down inverted yield curve. And that's not a healthy place to be. I mean, the financial system just doesn't work well when you have an inverted curve, because financial institutions borrow short and lend long. Typically, they borrow short at a lower rate and lend long at a higher rate. And that interest margin is their profit margin. And that's tied right to the yield curve. But with an inverted curve, short rates higher than long rates, it puts pressure on their net interest margins, their profitability, and it makes it much more difficult for them to kind of extend credit and provide the funding that's necessary to drive the economy forward. So it's not a healthy place to be, and that's why I think it is really important for the Fed to normalize here as quickly as possible. Particularly, they've achieved their mandate. Just get that rate down as fast as you can, so that something doesn't break somewhere in the economy, including in the financial system, because the yield curve is inverted.
So let's get to the Fed now. So obviously the Fed just recently reduced rates. There's expectations they're going to reduce them more. Before we talk about the impact that could have on consumers, on business, et cetera, just how do you see that playing out over the course of the next year? I mean, the series of rate cuts, et cetera, what the timing, size, what have you?
I'll give you my explicit rate path is they cut another quarter point at the December meeting. That gets the funds rate down to 4.5. And then they cut a quarter point each quarter until they get the funds rate down to 3%. And that's sometime in the early part of 2026. I think that's kind of roughly the path forward. They might speed things up if the economy starts to suck some wind. They might slow things down if inflation picks up. The election matters here. I mean, for example, if we get to the other side of the election and we have tariffs, that is inflationary, and that might cause the Fed to slow down its rate. I don't think it causes them to raise rates, because there's a lot of, it hurts the economy and it raises inflation, so they're not sure exactly what to do. But it causes them to freeze, and they'll slow down the rate cutting. So, but that path to 3%, and I think it's roughly 3%. That's an empirical question. It's open to a lot of debate. It's not written in stone, so we'll have to see. But that's my sense of things. That's kind of the path forward here. We'll get back to kind of a normalized federal funds rate target, a so-called equilibrium R star of 3% by early 2026. And by the way, I think market expectations are fully on board with that. I think investors are expecting a more aggressive kind of rate cut path, but they've given up on that in recent weeks, given the stronger job data and the firmer inflation data. And the market's expectations are very, very similar to the ones I've articulated for us.
You mentioned tariffs, and we're going to talk about those in a few minutes. Are there any other risks out there that would allow inflation to rear its head again? Do you feel like the inflationary pressures are now under control, or are there things out there that could change that? I get geopolitical risk would be one of them.
I think inflation's back to target. It's low and stable. I mean, in fact, if you look at that consumer expenditure deflator, if you exclude the implicit cost of home ownership, the owner's so-called owner's equivalent rent, that's implicit because no one pays it because most people have a mortgage that's locked in, so their mortgage costs aren't rising. But this is a way to kind of measure the implicit cost through looking at rents. If you exclude it, which I would argue one should do when trying to gauge underlying inflation, certainly in terms of determining the appropriate interest rate, it's 1.5%. And it's been there since the beginning of the year. So it's rock solid 1.5%. So I would argue, if anything, it's below target. I don't feel like we've got an issue there. But, obviously there are things that could happen that could disrupt that. I mentioned tariffs. The other thing I worry about is what I call Fed capture, meaning that the Federal Reserve is an independent agency that sets monetary policy based on achieving its two objectives, full employment and low and stable inflation. And politics should not enter into the decision-making process because we know historically when that happens, there's always the incentive for the executive branch, the president, to argue for lower interest rates to keep the economy juiced. That ultimately always leads to higher inflation. So I worry about that as well. So yeah, I think we could see a higher inflationary environment, but that would be a policy choice, a mistake that we made, not because of something inherent or fundamental that's going on in the economy.
Obviously, commercial real estate is heavily rate dependent, the Fed reducing the rates, although generally speaking, commercial real estate is driven more by long-term rates than short-term rates. But I would presume that you would see the lowering of rates by the Fed to be a positive for transaction volume in commercial real estate, and perhaps they take some pressure off the office sector particularly.
Yeah, I agree with you, Tom. I think the lower interest rates certainly help out the commercial real estate market. It takes a lot of pressure off. We were not too long ago flirting with a 5% 10-year treasury yield. Now we're down to 4%. I think that's a meaningful difference. And, I think that does help valuations and it should help with the transactions, particularly in the stressed market. So, yeah, I think that's a real positive development for real estate broadly and for CRE specifically.
Lower rates help the consumer as well. And one of the signs that we watch closely is just consumer debt delinquencies, which have picked up a little bit. Obviously, lower rates would ease some of the debt burden on consumers or the interest burden on consumers. Does that concern you, kind of the raising delinquencies in credit card debt and auto debt?
It does. That goes back to my point earlier about lower income households under a lot of financial stress. The good news there, Tom, is I think delinquencies have peaked or near a peak. We get data every month from credit bureau Equifax on all the credit cards, consumer finance loans, mortgage loans, the whole shooting match across the country. And it looks like the delinquency rate on credit cards has remained unchanged now for almost 6 months. And it does feel like all the trend lines here are positive. Most importantly, lenders have tightened their underwriting standards in the wake of last year's banking crisis. So the quality of the borrowers are higher. Actually more like they've normalized. The quality was actually reduced in a very significant way back 3 years ago coming out of the pandemic because of part of the COVID relief was that lenders could not report to the bureaus if there was any delinquency on their credit. And so credit scores got inflated and that caused underwriting to weaken and thus the higher delinquency rates. But we're on the other side of that. And the other thing, of course, is now the Fed is lowering rates and that should start to result in lower rates on credit cards, consumer finance loans, home equity lines of credit. We should watch this though, because, the credit card interest rate, I think I mentioned earlier, is 22%. That's a record high. And it's a record spread off of banks' funding costs. So there's some concern that there's not enough competition in the credit card market for lots of reasons. And we may not see rates come in as fast as they have historically. So I think that's something to watch very carefully. But I think rates are going lower and that should take some pressure off. So I'm hopeful that the worst of the credit problems that we've observed on cards, on auto, on consumer finance are in the rearview mirror now. And we'll feel a lot better about things next year.
Mark, one of the things that you were talking about credit card delinquencies, auto delinquencies, et cetera. And I heard you recently on a Bloomberg podcast, and you were talking a little bit around consumers and consumer spending on experiences. And we have seen that too, that there's a drop off in spending on experiences. Obviously with the higher costs of airfare, hotels, et cetera. Do you see that as a short-term phenomenon, a long-term phenomenon? Is there a signal we should be seeing from that should raise some concern around the economy?
No, I don't think so. I think it might be a bit of normalization. As you recall, during the pandemic, the teeth of the pandemic and the shutdowns, we couldn't travel, we couldn't go to ball games. We diverted our spending to spending on stuff, on goods. Then once the economy reopened and we started to get going again, we could travel again. There was a lot of so-called revenge travel. People really wanted to go out and experience things, restaurants and ball games and concerts. And now we're on the other side of that. It's starting to just normalize, get back to something that's more typical. Our spending patterns are normalizing. And that doesn't feel great when you're in the middle of that. But, once we're on the other side of that, which should be by this time next year, then I think we just kind of settle in. If you look at overall consumer spending, the whole shooting mat, everything, services through goods, the growth rates are rock solid. They're real after inflation, real consumer spending is year over year 2 to 2.5%, and it's been that way for 3 going on 4 years. And it's almost if you graph it, it's almost like someone drew a line to the degree that some people are arguing that the Bureau of Economic Analysis, the folks that put the data together, are actually drawing a line. There's a conspiracy theory. It's that amazingly stable in aggregate. There's a lot of churn underneath, as we've been talking about. But on the, when you look at the top line number or the bottom line number, whichever it is, it's like just incredible stability in spending. Just amazing.
The composition of the spending may change, but the trajectory and the straightness of the line hasn't changed. Well, that's good news. One of the items that you noted at the beginning of our conversation was, as a risk, was just the election. But regardless of who's going to win this, who wins this election, we do know that there's some major things that need to be talked about next year in 2025, one of which is tax policy. The Trump era tax cuts all sunset at the end of next year. So when you look at tax policy, and there's a whole series of things that need to be talked about, everything from personal tax rates to corporate tax rates to capital gains rates, et cetera, that were all part of those tax cuts back in 2017. Are there any of those items that are going to be talked about that raises some concern, or do you feel is that the economy is most sensitive to a change around?
Well, Tom, my sense is here's one thing that will be invariant to the outcome of the election, and that is I think the tax cuts for individuals will just be extended, perhaps for a couple of years, until the next election in 2026. That we just don't have the political bandwidth to do anything different other than kick the can down the road for a couple more years. Also, tax policy is very complicated. It takes a lot of energy in Washington for lawmakers to kind of work it through. In the TCJA, that's the tax cuts under President Trump, you had some really very smart people in Congress that have been thinking about tax policy for a long time that are no longer in Congress. Like Paul Ryan is the best example of that. He was Speaker of the House, but he was a policy wonk and really could usher through, changes in tax policy. We just don't have that right now. And so I just don't think there's going to be any change here. So there's a lot of other tax policy on the corporate side that needs to be addressed. And I think they'll kick the can down on the road on that. I think it's the status quo on tax policy.
And you mentioned tariffs also in the course of our conversation. Just talk a little bit about tariffs, the potential consequences if we end up with some significant regime around associated with tariffs and increasing tariffs.
Yeah, let me just first say I'm not dead set against tariffs if they're strategic. If they're designed for a very specific purpose and they're on a selected group of commodities with a very specific country in mind. Like, so for example, President Biden imposed $18 billion worth of tariffs on EVs and batteries and other technology with China. I get that, particularly in the context of a world where there's no other way to adjudicate trade differences. And using tariffs in a strategic way with a scalpel makes sense to me. Broad-based tariffs, universal tariffs, so-called universal tariffs across lots of products against lots of countries, that's just bad policy. We settled this 100 years ago. Hard to imagine that we're here back debating it again. But it's just a tax that's paid through in the form of higher prices on imported goods. So every American consumer, obviously lower and middle income households will get hit harder because a higher share of their budget go to these imported products, are going to have to pay that tax. Another way of thinking about it, it's like a consumption tax. And the other thing that happened, it's not going to create jobs, has been touted, because you're going to see other countries that are facing the higher tariffs from us impose their own tariffs and other trade restrictions. They're not going to stand still. They're going to respond. And that's going to cost us jobs. So the net of all this is going to be, no job creation, maybe some, if you do the modeling, some job loss. The other thing I don't like about tariffs is they're very capricious. They're very difficult to implement, very messy. Which products, which countries, which businesses, over what period of time. So it creates an enormous amount of uncertainty for businesses. They just don't know what the world's going to look like 6 months from now, a year from now, 2 years from now. And if they don't know, they can't plug it into a spreadsheet. If you can't plug it into a spreadsheet, you're not going to make an investment. You're not going to do the things you need to do to make your supply chains resilient and efficient and, make your business work. So, I think there's a long-term pernicious effect of tariffs that is underappreciated. It's very, very, it's a corrosive on the economy. So of all the things that policies one could pursue to help support the economy's growth, that wouldn't even be on the list. I'd throw that's in the trash can. That is like a really bad idea.
Got it. Let me ask you one other policy related item. One of the lessons I think of the pandemic was kind of the interconnectivity of the global supply chain. Obviously, we ran into some product shortages. Some would say that led to some of the inflation that we experienced. U.S. manufacturing, there's certainly been a trend to move some manufacturing back to the U.S. or at least nearshoring. First of all, do you see that as a trend that will continue? And are there policies that you think would be helpful to increase the U.S. manufacturing base?
Yeah, it is happening. Part of that is just the kind of the fallout from the pandemic and what we learned about supply chains during that very dark period. Part of it's policy. I mean, the CHIPS Act and the Inflation Reduction Act provide tax subsidy to manufacturers to build factories here and produce here. And that's in fact what they're doing. I mean, if you look at investment by manufacturers in facilities, factories, in the 10 years leading up to the CHIPS Act, it was about $75 billion per annum, give or take, pretty consistent. Last data point I looked at, speaking from memory, so I might not have this exactly right, but it's $225 billion at an annualized rate. So yeah, they are coming back and they've got, significant monetary incentives to do it. And part of that's just national security. A lot of it is around the chip industry. And we've learned, given the pandemic and given our relationship with China, we can't be dependent on Taiwan for chips. Just can't do that. We've got to bring that production back home. And that's what's happening. But a lot of it's also other manufacturing. A lot of it's related to clean energy, around EVs and charging stations and battery technology, solar and wind and all those kinds of things. So yeah, I think there has been a significant increase in manufacturing activity, and a lot of that just a result of the pandemic, a lot of it a result of policy decisions that have been made over the last couple of years.
There's one other topic I want to touch upon, which is the banking system, regional banks. Last year, 2023, there was Silicon Valley Bank, First Republic, a few others that collapsed. Some of that was concerns around debt related to the commercial real estate industry, specifically the office sector. Some of it was some other factors. Do you feel like that issue has subsided, or is that something that could rear its head again?
I think it's subsided, Tom. I mean, it goes to the Fed and other regulators' response to the crisis. They were very aggressive and creative. They set up the bank term funding program to help banks get liquidity on their securities portfolio, even though it was underwater because of the increase in interest rates. And of course, the FDIC showed a lot of forbearance and allowed the failing banks to effectively cover deposits of insured and uninsured depositors. But, having said that, I'll go back to that inverted yield curve. As long as the curve is inverted, I don't think we're home free in the banking system and the broader economy, because the banking system has a very tough operating environment. In an inverted curve, weak loan growth because of the tightening and underwriting in the wake of last year's banking crisis. Credit quality is weakening. It's still good by the historical norms, but it's moving in the wrong direction. And of course, the regulatory environment, I won't comment on whether the regulation is good or bad, but there's more of it and it's costly. And so that just makes the operating environment more difficult. So I think the banking system's on more solid ground. I don't think it's on solid ground, though. And it won't be until the Fed has completed its work here and normalized interest rates.
Before we conclude, the final question is looking ahead to next year in 2025 and just your outlook. I know there's a lot of unknowns and there's the so-called known unknowns, but look ahead, next 12 months, it sounds to me like you feel, generally speaking, with outside of the risks that you've identified, pretty good about where the economy's headed.
I do. I think the economy's on good fundamental ground. The only reason why it won't perform well over the coming year through the end of 25 is that we screw it up. Federal Reserve, doesn't get it right, doesn't lower rates and thread the needle appropriately. Yeah, I feel very good about the economy's fundamentals. We're in a very, again, I'll use that word exceptional spot, but that doesn't mean we can't mess it up. And that's what I worry about.
Well, thank you for that, Marco. We covered a lot in a short period of time. And I always appreciate your time and the opportunity to talk with you. It's just wonderful. Thank you, Mark, for joining us today on From Where I Sit.
Thanks, Tom. I really appreciate the opportunity. Always do, and anytime.
Please follow the show on Apple and Spotify, and please share it with others that might find it interesting.